Student loans can all sound a bit confusing, so in this video I'm going to try and make it as simple as I can for you. If you're from any country within the UK, then keep watching as this is going to help you out a lot. I'm going to cover the amount you're eligible to borrow, the interest rate you'll pay on this, what loan plan you're on, and then we'll go over some repayment strategies towards the end as well. So feel free to skip around to whatever part is most relevant to you. My name is Lucas and I make finance and investing videos as well as some about making money. So if this sounds interesting to you, then consider subscribing for more. So let's first start by establishing the difference in tuition fees from the different countries around the UK. So for Scottish students there are no tuition fees at all, zero. However, if you're from Scotland and you decide to study elsewhere in the UK, you'll have to pay standard tuition fees, which are £9,250 per year. Northern Irish students are charged £4,530 per year if they choose to stay and study in Northern Ireland. If they decide to go elsewhere in the UK, they'll have to pay the £9,250 as well. If you're Welsh and study in Wales, you'll get charged the same as everyone else, but that is slightly less at £9,000 instead of £9,250. A huge difference, I know. However, if you're from Wales and you decide to study elsewhere in the UK, you'll end up paying the £9,250. Finally, English students. There are no special offers for English students, so you'll have to pay the £9,250 wherever you go to uni. Now, we will go into more detail on each country and what you can expect to receive in the form of maintenance loans / grants. In every country in the UK, you'll have to apply to get your tuition fees and maintenance loans paid for through a specific service to your country. So I'm from Scotland, so we have to go through SAS to get our tuition fees or maintenance loans. Now, for tuition fees, this money will never actually reach your bank account. So if you are paying tuition fees, this money will go straight to the university. So you'll never see that £9,250, which is probably for the best. I feel like people would spend it on some pretty interesting things. Okay, now let's talk about maintenance loans, how much you can get depending on which country you live in, as well as your household income. Firstly, Scotland. If you have a household income of above £34,000, then the maximum loan that you can take out is £4,750. If you have a household income of less than this, then you'll become entitled to a bursary as well as a slightly larger loan. This continues to scale up until you have a loan of £5,750 as well as a bursary of £2,000. This will total £7,750, but you will only be eligible for this if you have a household income of below £21,000. Now, Northern Ireland. If you have a household income of above £41,065, then you'll be entitled to the standard maintenance loan, which you can see in the table here. The amount you get depends on whether you live with your parents, or if you're going to study within London or outside of London. So this means it varies all the way from £3,750 up to £6,780. If you have a household income below £41,000, then you may be eligible for a grant of up to £3,475. Also, because I forgot to say this already, I'll include all the links to the places where I found this information in the description, so if you want to find some more details, then you can just go look at that. Wales now. So if you're from Wales, then you're going to be balling at uni. Not really, but you do get a significantly higher maintenance loan. So to begin with, everyone from Wales who goes to university gets a minimum grant of £1,000. If you have a household income of above £59,000, then you'll be entitled to a £9,350 loan as well as your 1k grant. This totals £10,350 which you'll have in total. As your household income decreases, the grant you'll receive increases and the amount you have to loan decreases, as you can see in the table here. So this means it doesn't matter what your household income is, if you want it, you have up to £10,350 available to you. I think this is probably the best system of any of the countries really. It just means everyone has access to the same amount. Finally, England. They have a very similar structure to the other countries. If your household income is above £62,000 per year, then you'll receive a maximum loan of £4,422. This loan will increase the lower your household income gets. The amount you get also depends on where you're studying. So if you're studying within London, then you'll be able to get slightly more, whereas if you're studying outside of London, you get slightly less. So as you can see, the amount you receive for your maintenance loan is entirely going to depend on where you live and the household income you have. So look through the tables I've shown and try and find what situation is most like yours. If your household income is above the threshold where you receive the minimum loan, then you will likely have to rely on some kind of support from your family, as that amount of money isn't enough to pay for accommodation and food for the year. However, if you're from Wales, you could probably rent out a castle for the amount you get given in your maintenance loan.
This is my castle.
Great, so now we know what maintenance loans you're eligible for. So now let's talk about how you start repaying them once you've finished your course. Well, there are 2 and very soon 3 repayment plans, so it's important to know which one of them you are on. The main difference between these plans are the interest you will pay on the remaining student debt balance. So let's go through them and see which one you fall under. So Plan 1. This is for Scottish and Northern Irish students who have studied anywhere in the UK after 1998. It's also for English and Welsh students who started studying anywhere in the UK again, but before 2012. Plan 2 is simple enough, and that's just for English and Welsh students who started studying after 2012. Now, I said that there's another one, and that's because there is, or I found out very recently that there is. And this really only applies to Scottish students. So, as some of you may know, the Scottish threshold at which you begin to pay back your student loan has been increased this year, or April of 2021. Because of that, they've created a new plan which is going to be called Plan 4. I don't know what happened to Plan 3, don't ask me. So if you're on Plan 4, it just means that you have that slightly larger threshold before you start paying it off. Otherwise, it's pretty much identical to Plan 1, as in you pay the very same interests as Plan 1 does. So let's get started with the repayments then. But first, before we get into it, I think it's important to know that the way you repay your student loan is a lot more like a tax than a loan. So people tend to get quite scared of loans and debt, and they don't want to have any debt. But this is more like a tax, so it makes it a lot more manageable to pay off. You will soon see as we're about to go through each plan and how the repayments work. Plan 1, repayments. So firstly, you're going to pay interest on the remaining balance of your student loan every year. The amount of interest you'll pay varies each year, but it's usually between 1 to 2%. I'll show the history of the interest rates here, but really the interest rate is really quite low. It's actually lower than inflation. With Plan 1, your repayments will start when you earn above £19,895 per year. Once you cross this threshold, you will begin to pay 9% on all the income you make above that number. So if you're earning £30,000 a year, you will have to repay each month £75.79p. Or for the whole year, it will be £909.45. If you took out a Plan 1 loan before 2005/2006, and you are from England, Wales or Northern Ireland, then this debt will be completely written off if you haven't managed to pay it by the time you reach 65 years old. For students from Scotland, if you took out a Plan 1 loan from 2006/2007 or before, then it gets wiped again once you reach 65 years old, or after 30 years from when you first become eligible to start repaying it, whichever one comes first. If you took out your Plan 1 loan after 2005/2006 and you're from England, Northern Ireland or Wales, then your debt will be completely wiped 25 years after you start paying it off. For Scottish students, it's 2006/2007, so if you took a loan out after that, your debt will be completely written off after 30 years from when you first start repaying it. Plan 2 repayments work slightly differently. The main difference is the interest. This interest depends on how much you are earning. If you're earning less than £26,575, then you will just pay the retail price index of 2.6%. If you earn between this and £47,835, then you will pay the retail price index of 2.6% plus up to 3%, usually slightly lower. If you're earning above £47,000, then you'll pay that retail price index of 2.6% plus the full 3%. So that'll total 5.6%. The threshold to start repaying Plan 2 loans is £27,295. So again, once you earn more than that, you'll start to pay 9% of all your income above that number. This means if you're earning £30,000 a year, you will pay £20.29p each month, or for the whole year, £243.45. All Plan 2 loans are written off 30 years after you start repaying it. Finally, Plan 4, which is just for our Scottish students. This has the same interest as Plan 1, which is around 1.1% currently. The threshold we mentioned had just been increased, and it's been increased to £25,000. So again, once you earn over £25,000, you'll start to pay 9% on that. This means if you have a salary of £30,000, you will pay £37.50 each month, or for the whole year, £450. Plan 4 loans are also written off after 30 years from when you start repaying it, just like Plan 2 loans. So a common question would be, should I make additional payments toward my student loan to try and pay it off quicker? So usually this would be because you got a bit of extra cash lying around, or you started to earn a little bit more and you feel like you could make some extra payments just to try and get rid of it quicker. Well, this might not always be a great idea. We'll talk about that in more detail now. However, just to remind you, I'm not a financial advisor. This is not financial advice, it's just my opinion, and it's just meant to be for educational and entertainment purposes only. So always do your own research. If you're on Plan 1, then you're probably the most likely to actually pay back the full amount. This is because there's really quite a low interest rate of 1.1% currently. So this means if you did pay it back a little bit quicker, you would save some money on the interest that's building up. However, if you didn't, then it's also not too big a worry, because that 1.1% is really quite low. So if you can put your money where it's getting a higher return, so if you've invested it into something or you're using it to buy property, for example, then that's completely okay as well. It won't really matter too much. Plan 2, however, has much higher interest rates, and also you have access to larger loans, so this means it's probably unlikely that a lot of people will pay this off before the 30 years is up. So unless you're in a very high paying profession, or you're starting your own business, or you're doing something which you think will get you a lot of money, then you can probably assume that you might not be able to pay it off by the 30 years. So if we assume this, that you're not going to be able to pay it off, then there's no point making additional payments. Since you're not going to pay it off, you just keep paying the basic one, and you'll end up getting it written off after 30 years. However, obviously if you do think that you're on track to actually pay it off, then making additional payments could be useful, as it means less interest will build up on it, so you'll pay back less in total. Plan 4, which is slightly different from the other two, will again just depend on your income. Plan 4 has a really low interest rate, but that being said, it does have quite a high threshold now, so you won't start paying it back till quite late. So again, like I said for the other two, if you think that you're on track to actually pay off the full amount, then overpaying and making additional payments might be a good idea, as you'll save some money on the interest. However, if you don't think you're going to end up paying it off, then there's no point making additional payments. And just like we said with plan 1, because the interest rate is low at the moment, don't worry too much about making additional payments if you feel you can't, or if you're putting that money to better use somewhere else. So now you should have a much more clear understanding of what student loans are all about. So you should now be able to identify how much you are eligible for in maintenance loans. You should also be able to say what plan you're on, whether that's 1, 2, or 4. You should also know how much interest you're paying on that student loan balance, depending on which plan you're on. And finally, you should have some ideas about your repayment strategy, like we just talked about. So if you did find this video useful, then please leave a like, I would hugely appreciate it. Also comment below and tell me what kind of strategy you're going to be following to pay it off. Also, just a reminder, I will put all the links to the websites where I found this from the varying different countries, so you can do more research yourself. Subscribe, please. It's Friday then, it's Saturday, Sunday, what?